Last year, we may have done well or not, but over the last 5 years, 10 years, 3 years, think longer, look longer, your returns do tend to kind of average out, and then you can have some consistency. The same is true for income seekers. Diversify your income streams, especially if we're looking at bonds. Um, I have always been a fan of kind of middle duration bonds. I like things that mature or we're able to kind of recuperate our investment. 5 to 7 years is a good maturity. The reason why I like that is because the front end and long end of the curve. So short-term interest rates, long-term bonds kind of do this over time. And I just like to be kind of right in the middle where it's kind of steady and then let it slide a little bit back and forth based on the allocation. So just be very careful where you're pulling your income. If you're in a situation where you've been used to having high income or high yielding bonds that also have good price appreciation, that may change if the Fed cuts rates. And so you want to be prepared for that. If you have a lot of cash sitting in a high yield savings account, you may be prepared for that yield to decrease as the Fed cuts rates. Business owners, lower rates mean lower borrowing costs. That could be a great chance to refinance debt. It could be a great chance to go ahead and fund some expansion. Maybe you shore up your working capital. Maybe you get your credit cards situated. Whatever it is, it gives you the chance to look at your debt structure and realign it with new cash flow realities.